Greg Peters is at PGIM. It's very important to speak, I think, today on the management side of things, of running portfolios, but far more, he combines that with tours of duty at Salomon Smith Barney. This is ancient. Columbus had just left.
Yep.
Salomon Smith Barney and at the U.S. Treasury, and of course, iconic work when I first heard of him at Morgan Stanley as well. Greg Peters, compare this moment to the other analogs out there. Is it a 1998 redux?
No, I think it's very different this time, Tom. You touched on it with the SOFR spread. I know that's kind of an in the weeds type of measure, but I think what you're seeing here, and you're seeing it in kind of the correlation in the price action, is risk premium being put into the entire U.S. rate curve. You look at the price action over the past few days. Stocks have, sold off, and, you haven't really seen the bond market react, or at least react, as a kind of a defense mechanism. So, the markets are very nervous on the bond side around debt and deficits, foreign buyers stepping away in a meaningful fashion. And there's a lot of technical unwind. So this is a very sloppy, ugly bond market right now.
Within it is the question of liquidity. You've got Tripp, you've got Peters, you've got Porcelli when he decides to show up for work. Within the holistic PGIM view, are we edging towards a liquidity freeze up where the Fed needs to step in?
I think at some point that is almost inevitable. And I don't want to be a doomsayer, but I do think it is inevitable. At the same time, things have actually been reasonably okay and orderly, but there's only so much capacity to absorb, treasuries, and the dealer balance sheets just don't have enough of that capacity. So I think it's inevitable, but we're not there now. This is an incredibly important week, of course. We had the 3-year auction yesterday. We have 10s and 30s today. That's a lot of duration entering the system. And so we'll have more, informational content to see how, that notional kind of gets absorbed into the system.
I'm not going to show this on YouTube because people will drive off the road if they're watching the Rivian. But Paul, I just had to reset the standard deviation study on the 10-year SOFR spread because it's moving so fast. We're now down, and folks, I'm not going to do the math this morning. Peters will hang up and go work out. But the bottom line, Paul, I'm looking at 4.6 standard deviation move in that spread. You and I started the show at about 3.7 standard deviations. This market's moving.
This market's moving across the board, and we'll keep you on top of it. Greg, you mentioned kind of the weaker than expected auction yesterday. We have more duration today from the Treasury as the issue. How important, if we have another week showing today, what would that tell you?
Oh, well, it means that there's just somewhat of a buyer strike, right? And so our read on yesterday's auction is, not a lot really came from it from an informational content standpoint. I think today is the important day. Watch the tail, watch the bid to cover. It's important to note that, we can't have a failed auctions, right? The dealers must take it down, but that doesn't mean it can't trade, in a sloppy, ugly fashion. So that's a lot of duration hitting the market at a time when there is a massive selling of treasuries across the board. So it's going to be very, very interesting. And the volatility is really extreme. I think it's important just to kind of note that the 10-year has traversed like almost a 60 basis point range in just a few days. Yep. Talk about standard deviation moves, Tom. That's that's just eye-popping.
Paul, I've got since April 4, the 10-year, and nobody ever quotes price except Liz Goldenberg. See the scar here?
Sure.
That's a Manolo Blahnik heel. She got so angry at me, she threw the shoe at me. It bounced off the terminal and hit me in the face. The price of the 10 years down 3.47%. in 1, 2, 3 days. That annualizes out to a 92% per year loss.
Oh boy, it sounds like 2022
It's a
again.
little bit hyperbolic there, folks.
Exactly. Greg, who's been selling here the last several days?
Well, there's been, a few factions. There's been lots of talk around foreign selling. We'll know that for sure, when the data are released. But that's, a clear conversation in the marketplace. But you're seeing a lot of kind of levered unwinds. There was a very popular basis trade that, been talked about a lot, over the past couple of years. But kind of entering this year, there was a belief that, SLR type of relief would, come on board, and there was a loading up on that type of investment, which is, long treasury, short futures, and the stop outs and the unwinds are, pretty substantial. So there's just kind of broad-based selling, I'd say. There's a raising of dollars and, exiting, the U.S. bond market. I think it's also important to note that trading partners, if their trading volumes are going down or going down to zero, the need to hold U.S. Treasuries just becomes a lot less. So, that's just a natural byproduct of, trying to reduce trade, right? And that's an unintended consequence that, I don't think the administration really kind of thought through.
Greg Peters, thank you so much. About 8 more questions, but we can't get there this morning. Mr. Peters, of course, with his work at Morgan Stanley and Salomon Brothers, he's with PGIM across the Hudson.